Condos have historically been one of the most affordable paths to home ownership. The median price for a condo or co-op was $380,000, compared with more than $446,000 for a single-family home as of June 2026. But buying a condo may be about to become significantly more difficult, even for buyers with good financial standing. That's because prospective home buyers eyeing a condominium may soon discover that mortgage lenders are just as interested in the condo building as they are in the buyer. Beginning August 3rd, Fannie Mae and Freddie Mac are making big changes to how condominium mortgages are reviewed. The two government-sponsored enterprises play an outsized role in the housing market, backing roughly 70% of all U.S. mortgages.
They provide liquidity and access to financing for residential real estate in the U.S. Once a bank or a mortgage company originates mortgage, they can sell this to Fannie Mae and take that money and go do another loan. A lot of other financial organizations like banks, private mortgage companies, and other financing funds and credit unions, they follow Fannie and Freddie guidelines. So its effect is trickling down. That's why the changes, even small changes, are extremely important and have gigantic effect on the U.S. residential market.
In the past, many condo purchases qualified for a streamlined review process that required minimal documentation, but under the new standards, that process will be retired. Instead, lenders will now have to conduct a more comprehensive review of a condo association's finances, reserve funds, insurance coverage, and the building's overall condition before the mortgage can go to Fannie Mae or Freddie Mac. Industry groups estimate that roughly 40% of condo purchases with mortgages that previously qualified for the streamlined process could now require a full review. For buyers, this could mean a longer and more complicated mortgage approval process, and in some cases, buyers with excellent credit and strong finances could still be denied a mortgage because of problems with the property itself, whether that's inadequate reserve funds for future repairs or unresolved maintenance issues within the building. Some buyers may be able to find lenders willing to keep the mortgage on their own books rather than sell it to Fannie Mae or Freddie Mac. But that flexibility could mean a higher down payment or higher interest rate on the loan. As a result, some experts argue that these changes could have a significant impact on housing affordability in the U.S.
We believe that if the rule takes effect, this will worsen housing affordability, because in some cases where you do not qualify for Fannie and Freddie full review, your alternative route may require a little higher down payment, and that's what impacts the affordability. We truly hope that FHFA and Fannie and Freddie could either postpone or modify that rule. We heard that there are talks going on inside agency considerations, and we truly hope that something could come out of that.
These changes can largely be traced back to one of the deadliest structural disasters in American history. The 2021 Surfside condominium collapse killed 98 people. An investigation later found that severe design and construction flaws dating back to 1981, combined with decades of deterioration, contributed to the tragedy. In response, lawmakers and policymakers enacted major building safety reforms. Now, those changes are beginning to reshape the mortgage approval process for condo buyers as well. The new lending standards are a reminder that buying a condo has always meant purchasing more than just four walls and a front door. Buyers are also investing in the financial and structural health of an entire building. Moving forward, mortgage lenders won't simply be asking whether you can afford a condo, but they'll also be asking whether the condo building itself is worth financing.